Hello, everyone. Today is Tuesday, January 25th, 2022, and this is Crypto Big Law back with another blockchain legal news update where we cover developments in blockchain related policy, regulation, and the law. So, as we can see here, our top headlines for today are that the Trump family recently discovered TrumpCoin and they're going to take legal action against this TrumpCoin. Coinbase launches a free tax center to aid in the filing of taxes if you are a Coinbase user. Bank of America shills for US-based CBDCs or central bank digital currencies. The Tornado Cash founder claims that Tornado Cash is unstoppable. Uniswap's founder's bank account was shut down over allegations that it was involved in shadow banking. And Coinbase poaches SEC employees in this continual trend of private industry poaching some of the more established players in government and regulatory spaces. So before we continue, as always, if you like this content, please hit the like button below. Also, please subscribe to our channel. We'd really appreciate that. And you can follow us on Twitter. Our handle is @CryptoBitLaw. So let's dive on in. Before we cover the headlines, we'll just take a quick look at the market and how the market's performing right now. We can see the total crypto market cap. It's still continuing this downtrend. It's currently sitting at about $1.629 trillion. So it's continuing that downtrend despite that rally that we had yesterday. And if we look at Bitcoin, Bitcoin is currently trading at about $36,711. It's following, it's kind of printing a little green candle here, but I don't know. I think that the jury's still out on whether or not this is a true bounce back up towards a higher trend, or if this was just a fake out. So that's what the market's doing. Let's dive into these headlines. So first up on the docket today, we can see that Decrypt reported that the Trump family discovers TrumpCoin and noted that legal action will be taken. Eric Trump took to Twitter to warn his followers about a meme coin called TrumpCoin, labeling it a, quote, fraud. They say, a meme coin called TrumpCoin has caught the attention of members of the Trump family, and they were not amused. Donald Trump's son, Eric Trump, today tweeted that TrumpCoin has nothing to do with the Trump family and is not authorized, and, quote, legal action will be taken. You can see here is a reproduction of this tweet by Eric Trump. Pretty much, I guess the symbol of the coin is Trump. And he's, further stating what was stated above that it has no affiliation with the Trump family and they intend to take some sort of legal action. Now, traditionally, in this sense, when you would try to get any sort of legal action, what they would do is they would go to a court. First, they would eke out who's actually behind this project. And so you could do that with checking out the domain name registrars, any public information about who is associated or affiliated with this project, and use that to name the parties as defendants in a potential lawsuit. And then what they would ask the court to do, the Trump family that is either ask for a temporary restraining order, a temporary or permanent injunction, and damages. So as we've stated before, an injunction is an order from a court to tell someone to refrain from doing something, to stop from doing something. And the TRO is essentially a expedited fast-track means of doing that, to get the court to get an order to refrain someone from doing something, to stop a particular type of behavior. Continuing on, they say on its website, the TrumpCoin frequently asked questions says that it launched on February 20th of 2016 to honor former President Donald Trump. It calls itself the #1 patriot cryptocurrency on its Twitter account. The current market capitalization of TrumpCoin is around 1.5 million, with a circulating supply of a little more than 6.6 million coins, according to data from CoinMarketCap. The coin currently has almost no trading volume, though it did spike by more than 350% today, likely as a result of Eric Trump's tweet. So as we can see, I mean, there's virtually no liquidity in this thing. It's just kind of sitting there like a traditional meme coin that doesn't really have any volume, no real function or purpose to this thing. It continues, TrumpCoin isn't the only meme coin targeting right-wing Trump supporters. Earlier this month, NASCAR rejected sponsorship of a meme coin called LGB coin. The acronym LGB stands for Let's Go Brandon, a phrase that has itself become an internet meme and is used as a placeholder for F Joe Biden. Okay, so we can See, I know that this happened before, back in some of the earlier days of crypto. There was a coin that came out back when I first got in. It was called Coinye, and it was the logo was I think in kind of like an amalgamation of Kanye West with his like stunner shade glasses, imposed on a fish with a chain, and then Kanye, once he got wind of that, kind of quickly put an end to it. Let's see if we could find anything on Coinye. It's actually pretty interesting. Coinye. Yeah, Coinye. The now, so yeah, you can see right here, this was the logo, and then Kanye, he ended up filing a trademark infringement lawsuit and shut it down. It was used the script-based algorithm. It's the same algorithm that's used in Litecoin and Dogecoin. But I remember that. I thought that this was funny. This is just kind of a continuation of the same thing. These meme coins come up, and then the famous individuals that they're based on end up getting pissed and then filing some sort of suit in court to get injunctive relief or damages. So next up, we could see that Decrypt reported that Coinbase launches a free tax center as the IRS deadline looms. Filing taxes, crypto or otherwise, is no fun, but for Coinbase customers, the process will be slightly less painful this year. In brief, this article pretty much covers the fact that Coinbase's new service will help streamline the tedious process of calculating crypto profits, and the company does not plan on issuing 1099 forms. They say, for Coinbase owners, that burden, the burden of filing taxes on your crypto gains, will be slightly easier than in the past years thanks to a new, quote, tax center that the company has launched that will display their taxable activity, including short and long-term gains and losses, in one place. The new offering is significant since, in the past, crypto owners had to manually calculate how much profit they earned and what tax rate applied to their profits. The government taxes crypto, like other assets, at different rates depending on whether you owned it for a year or more before selling. That's pretty much the differentiation between long and short-term capital gains. As we can see here, this is a screenshot of the new crypto tax center issued by Coinbase. Seems pretty nice. Maybe I'll be taking advantage of that this year. In the past, the government focused primarily on searching out crypto whales who sought to dodge paying taxes. But in the last 2 years, the IRS has sought to cast a much broader net, including using the Common Form 1040 to ask every American if they own crypto. And this is just a reaction to the further widespread adoption of cryptocurrencies, particularly in the United States. You know, they see this trend of, millennials, Gen Z, even boomers and Gen Xers jumping onto the crypto bandwagon, engaging in this digital asset trading, and it's only natural that Uncle Sam is going to want its piece of the pie. So continuing on, they say that while Coinbase's new tax center will make tax filing easier for many of its customers, the company is not taking the steps of issuing a so-called 1099, the form used by banks and brokerages to tell customers how much money they made from dividends and investments. A Coinbase spokesperson told Decrypt that the company does not have a legal obligation to issue 1099s, though they will issue one to those customers who own significant income through fees and rewards. Quote, we do not issue 1099s for the sale of crypto assets as it is not required by the IRS. Coinbase will provide 1099 MISC IRS forms to customers who earned more than $600 in fee income and rewards for the 2021 tax year, said the spokesman. So I guess that this touches on the fact that they're just not going to engage in a general blanket issuing of a 1099. I know that if you have something like a TD Ameritrade account or Merrill Lynch or something like that, just automatically they're going to issue you a 1099 that's going to have all these different boxes with numbers filled in, and then you just kind of go through on your taxes and then just match up the boxes, and it calculates. Pretty much it is what the brokerage is going to send to the government as a report of what gains that you have and what your tax responsibility would do. And so when you get one of those, you better believe you better put that and claim that on your taxes, because you better know that the government and Uncle Sam is going to have a copy of that, and they know about it, and so you're on the hook for it. You're also on the hook for all of this, but the difference is that Coinbase isn't going to, as a general blanket rule, issue you a 1099. It's your obligation to self-report to the government all of your gains, and they are releasing this new tax product in order to help and aid people to do that. The exception is when you have over $600 in fee income and rewards. So if you are staking on their platform and you earned over $600 in staking rewards, they're going to 1099 you for that. I know that they also have this Coinbase Earn program where you can earn free crypto. So if the aggregate of all of your Coinbase Earn holdings plus what you made in staking rewards is greater than $600, you better believe they're going to ping you and let Uncle Sam know that you made this money. And they're going to put Uncle Sam on notice that you are responsible for this gain. So I guess in sum, file your taxes. Everyone should file their taxes. Don't try to cheat the tax man. It won't end up good. Turning to our next topic, we could see that CoinDesk reported that Bank of America says a U.S. CBDC, or central bank digital currency, would preserve the dollar's status as the world's reserve currency. CBDCs are an inevitable evolution of today's electronic currencies, the bank's analyst said. They say a U.S. central bank digital currency, or CBDC, would differ from the digital money currently available to the public because it would be a liability of the U.S. Federal Reserve, not a commercial bank, and so would have no credit or liquidity risk, Bank of America said in a report. Preserving the dollar's status as the world's reserve currency, improving cross-border payments, and increasing financial inclusion are all seen as benefits of a U.S. digital currency. Analyst led by Alkesh Shah wrote in the note Monday. The Fed published a discussion paper last week on the benefits and risks of a U.S. CBDC. They note that the potential risks, which could be diminished by CBDC design choices, include, quote, changing the financial sector's market structure by shifting deposits, increasing the liquidity risk of the financial system if deposits at commercial banks were converted to a CBDC, and decreasing the efficacy of monetary policy implementation, the note said. Bank of America said key considerations before issuing a CBDC are the need for it to be privacy protected, intermediated, transferable, and identity verified. Now, it almost seems like that's kind of an oxymoron, the whole identity verified and privacy protected thing, because we all know that if the Fed were to issue a CBDC, they would have complete hegemony over the entire process, complete vertical integration based on their knowledge of who is transacting on the blockchain, and complete total power over the actual issuance and flow of this CBDC. So, continuing on, in a report published earlier this month, Bank of America challenged the Bank of England's assertion that a UK CBDC would act just as a form of digital cash. It said, CBDCs are likely to replace checking accounts as the way in which consumers hold the majority of their funds. Now, I wouldn't dispute that last point. And all in all, I'll say that this is just a continuing trend of the sovereign nations coming closer towards the inevitable goal of releasing these CBDCs. As we mentioned yesterday, where there was a report that South Korean National Bank is in the second phase of testing its CBDC. All throughout the world, there is this trend of governments coming closer and closer and closer towards issuing a CBDC and trying to figure out the best way and the best technology to use to implement them. So, interesting stuff. We'll see how this ends up shaping out in the future. Turning to our next story, we can see that CoinDesk reported that Tornado Cash's co-founder says the Mixer protocol is unstoppable. Roman Semenov says that the Tornado Cash protocol is designed so that a third party can't control it. They say, the co-founder of Ethereum's best-known coin mixing service says that the privacy protocols are defending people's rights to financial privacy. Tornado Cash, a mixer that allows users to obfuscate their digital trail on the Ethereum blockchain, has been at the center of attention since it was revealed last week that the hackers were using it to mix their stolen Ether from digital assets exchange Crypto.com. And we covered that story last week. There was a hack of Crypto.com where some of these hackers ended up making off with millions of dollars that were plundered from wallets held on the exchange. And it was revealed that these hackers did the, I guess, criminally smart thing to mix those funds through this Tornado Cash protocol in order to prevent the transactions from being tracked on what is a public and immutable ledger, the Ethereum blockchain. And I'll also remind you of what happened with the Colonial Pipeline hack last year, where hackers ended up getting paid a ransom in Bitcoin as a result of hacking that Colonial Pipeline. And ultimately, the fact that the Bitcoin transactions were public is in part how investigators were able to track them down. So, I mean, I guess the smart thing would have been for them to use some sort of mixing service or tumbler to hide their tracks, but apparently they didn't, it raises an interesting question. I mean, if you're smart enough to know how to hack something as sophisticated as a pipeline and actually use crypto, you would think that if you're an elite level hacker like that, you would have knowledge of these privacy services. So something there just doesn't add up with that Colonial Pipeline thing. But I guess that's besides the point. Just an interesting corollary. Let's turn back to this story. They say all the deployments, protocol changes, and important decisions for Tornado Cash are made by the community via Tornado Governance DAO and deployment ceremonies. Those are events when new code is actually published live. So there's a DAO at the heart of this program. And for those of you that don't know, that stands for a decentralized autonomous organization, which is a way to implement governments in a decentralized manner. The way that the protocol is designed, decentralized and autonomous, much like the financial DeFi protocols, means that there's nobody in charge. There's no corporate office, executive team, or CEO where the buck stops. Simonov said that there's no backend and the user interface comes from an Ethereum name service domain, a service that represents Ethereum addresses as a familiar sounding domain name. The protocol was specifically designed this way to be unstoppable, because it wouldn't make much sense if some third party, like developers, would have control over it. This would be the same as if someone had control over Bitcoin or Ethereum, the founder said. It continues that Tornado Cash isn't the first service to offer the users the ability to mix or tumble their crypto. These have been around since the beginning of the blockchain technology, with development efforts increasing in parallel to the ubiquity of darknet markets like Silk Road or AlphaBang. It finally continues and says that in the 90s, the government claimed that no strong encryption should be available to people at all, arguing that it would help terrorism, the founder stated. In the late 2000s, there was a similar fight over end-to-end encryption in messengers where people were defending their right to private communication. Now, in the 2010s and 2020s, crypto is the latest frontier, and Simonov said that his efforts in defending people's rights to financial privacy are, quote, the continuation of the same story that started a long time ago. He stated, "Can you imagine the world where the cypherpunks conceded from the start and we wouldn't even have HTTPS encryption of our web communications?" So pretty much this story touches at the heart of the balance between privacy and security and transparency. And it's pretty much governments and enforcement agencies spreading FUD that a lot of these sorts of services promote criminal activity and that they could aid in money laundering or whatnot. But I think as it's clearly shown here, just the fact that they exist and no one is at the heart of it, and that a lot of these individuals that are involved in these programs do not know or should not have known, they don't have any direct knowledge of the fact that certain individuals are using these services or could use these services for nefarious means. It's just like a tool. Just because someone invented a gun doesn't mean that the inventor of the gun is responsible for all of the deaths that occurred as a result of guns. So, interesting take, interesting read. If you'd like to learn more about it, the article here is going to be linked in the comments below. Next up, we can see that Cointelegraph reported that Uniswap's founder's bank account was shut down by JP Morgan Chase, and as a result, shadow debanking allegations are starting to come to the surface. They say banks do not need to provide an explanation to shut down accounts owned by clients deemed, quote, too risky, according to former CFTC Commissioner Brian Quintins. On Sunday, Hayden Adams, the CEO and founder of the popular decentralized exchange, or DEX, Uniswap, claimed that his JP Morgan Chase bank accounts were shut down with no explanation. Former Commodity Futures Trading Commissioner Brian Quintins responded with a comment suggesting that the move was likely an instance of, quote, shadow debanking of crypto by the Federal Reserve's and Office of the Comptroller of the Currency Bank Examiners. Quintins explained that the banks are contractually prevented from telling customers the reason for ending the business relationship if they deem them too risky. Although most users commiserated with Adams on the alleged debanking, Others maintain that there is no universal right to a bank account, and therefore banks have the discretion to act as they deem fit. It continues that customers' risk levels to a bank are typically assessed based on regulatory compliance. Although the motives for the debanking are unclear, the Securities and Exchange Commission initiated a probe last December into the DEX's developers regarding the marketing and investor services they provide. Under U.S. financial regulation, broker-dealers are required to register with the Financial Industry Regulatory Authority, or FINRA, before they can facilitate clients' trades. However, because funds are stored in consumers' wallets instead of the Uniswap DEX, and cryptocurrencies are not classified as securities, Uniswap, like other DEXs and decentralized finance protocols, do not need to register with relevant regulatory bodies. According to CoinGecko, Uniswap is currently the largest DEX globally with a 24-hour trade volume of 2.74 billion. And so I think what we have here is just it's the continuation of this pattern of the government and big banks and regulatory agencies attempting to crack down on this large wave of DeFi that we're seeing in the space. Because if individuals are able to operate within a DeFi level and they're not tracked on any sort of centralized exchange, it leaves them in a position, the regulators that is, where they don't really have any sort of control or knowledge as to what is happening with these individuals in their transactions. It takes a lot of the control out of their hands. Even though the transactions are public, as we saw in the previous story, when you have access to these privacy protocols like Tornado Cash, you can get on a DEX, do a swap or a trade, and then run it through something like Tornado Cash and maintain yourself completely off the radar. I know that there was a recent push by Senator Elizabeth Warren, who is a large opponent of DeFi, and she looks at DeFi as an entire threat to the traditional banking and regulatory framework, which is kind of shocking because she claims to be one of the largest opponents of big banking and big money. But here at the same time, you have this new paradigm of DeFi that questions that traditional narrative, and she is one of the largest opponents to this. So I think that this is a very interesting development, how regulators and large banks are coming after big players in the DeFi game, attempting to disrupt them and their activities by essentially blocking their ability to fiat on and off ramp from these systems. And in our final story, we could see that Coinbase taps SEC counsel Taya Knight to manage public policy team. Knight's move follows Commissioner Elad Roisman's departure last week. They say crypto exchange Coinbase has hired former U.S. Securities and Exchange Commission (SEC) employee Taya Knight as its senior public policy manager. Coinbase confirmed to CoinDesk on Monday. Also, on Friday, Roisman, who was mentioned previously, he also left his position at the SEC after serving as commissioner since 2018 and acting chairman from December 2020 to April 2021, when Jay Clayton stepped down and before Gary Gensler took over. Roisman had announced that he would be leaving the SEC in December and has not indicated where he is going. So this story is a continuation of this trend of the large centralized players in the crypto space, entities like Coinbase or Binance or I forgot the name of the one where Brooks ended up going, Brian Brooks. These large entities are poaching pretty much all of these government regulation employees and putting them into high-level positions in order to leverage their knowledge and experience to navigate this regulatory framework. Previously, we saw this with Binance taking Brian Brooks, who was the former comptroller. They hired him and then put him in an executive position at Binance, and then soon thereafter, Brian Brooks left and went to another blockchain-related company. But this is a part of the pattern and practice of these larger crypto-related institutions poaching former government employees and using them to leverage their experience in hopes of gaining some sort of favorable treatment as the broader regulation of this crypto space begins to take fold. So, with that said, that pretty much wraps it up for today. I hope you guys enjoyed this content. If you liked it, please hit the like button, subscribe to our channel, and follow us on Twitter. Our handle is @CryptoBitlaw. And with that said, thanks for watching, and we'll see you guys next time.